Everybody is trying to figure out if interest rates are going to go up or are they going to go down. After Liberation Day, they crash.
2- and 10-year yields are on pace to close at lowest yields in 6 months.
But then afterwards, there's stagflationary fears and they skyrocket higher.
Does that create a risk? Absolutely. It creates a risk of inflation to me. It creates a risk of higher long-term rates.
Well, the good news is I have discovered a very powerful AI tool that will help you better determine where interest rates are headed throughout the rest of 2025 and beyond. I'm going to reveal this to you in 3 simple, fast steps. Step number 1, I want to share with you a hidden secret about interest rates. And then in the next step, we're going to go over that AI tool in more detail. But let's start looking at a chart here, going all the way back to June of 2023 to today's date. On the left, we go from 0 up to 250,000. So this is the ADP payroll number. So going back to June of 2023, right around 150,000, trend is down. We had this big spike up and kind of this volatility. And you can see it looks a little bit different. But what I did is instead of using these bars, I just used this line to kind of smooth it out, gives you a better idea of the overall trend. And then at the end of 2024, we see this big spike up, huge job growth, most likely due to Trump being elected and those animal spirits. But since that time, look at the trend, this red line, if you couldn't tell. It's going straight down to the point where just the other day, the ADP numbers came in at 37,000. Now that might sound like a lot, but for an economy of 350 million people, that is terrible. And expectations were for 110,000. So a huge miss. And the month prior was 62,000, and that even got revised down to 60,000. Now, I know a lot of you right about now are saying, okay, George, well, so what? So the labor market's deteriorating. What does this have to do with your powerful AI tool that will help me better predict interest rates? Well, it's all about understanding what really drives rates at the long end of the curve. And to be specific, when I'm talking about interest rates in this video, I'm referring to the 10-year Treasury. That's what most people care about because that's what really impacts all of those interest rates in the real economy, such as mortgages. So let's go over that for a moment here. The main driver at the long end of the curve, which I say in a lot of my videos, but it's worth reiterating, is inflation and growth expectations. Now, a lot of people think that it's deficits or debt, but editor, go ahead and throw up a chart of nominal GDP going back, let's just say, as far as we can, maybe 50, 75 years. And you can see that when you line this up with a chart of the 10-year Treasury yield, there's a very strong correlation. Now, if we throw up a chart of the deficits and the debt, let's just say going back to 1980, and then the 10-year Treasury yield, you see there's almost an inverse relationship. So the higher the debts go, the bigger the deficits get, the lower yields tend to go. And we saw this exact same phenomenon play out in Japan. So we have to focus on this, growth and inflation expectations. And the real key here, the real secret, if you will, is that rates, interest rates, don't control the economy. So many people get this backwards. They think that whatever the interest rate is, so if the Fed just drops rates, that means it's going to stimulate the economy. And we're in for good times, going to be running on all 8 cylinders. When in reality, interest rates merely reflect what's happening in the real economy or what the market expects will happen in the future. Now, I'm sure a lot of you are saying, well, what about the Fed, George? The Fed is who really controls interest rates. And when we look at the long end of the curve, absolutely not. So as an example, editor, go ahead and throw up a chart of 2024. You guys remember September 18th when the Fed started dropping rates. They dropped by 50 basis points. And then throughout the rest of 2024, they dropped by 100 basis points. Well, what did the 10-year Treasury do? Did it go down because the Fed was dropping rates? No, it did the complete opposite. It went up by approximately 100 basis points during the same time frame. And why did interest rates go up so much when the Fed was dropping at the front end of the curve? Because inflation and growth expectations were increasing. Another more recent example I would give you is from CNBC. This article talking about how the ECB is dropping rates because their inflation numbers are much lower than expected. And if you scroll all the way down to the bottom of the article, you'll see it states growth has been very weak, even though they have been dropping rates to try to quote unquote stimulate the economy. So once again, the point here is interest rates are a reflection of what's happening in the economy. They do not control what happens in the economy. So this takes us right back to the labor market and this chart of the ADP payroll numbers. So in the past, when you have seen economic contractions, which means this is coming down, therefore you would expect interest rates to do the exact same thing, you've seen substantial spikes in the unemployment rate. So the labor market getting weaker and weaker and weaker. And editor, go ahead and throw up a chart of the 10-year Treasury yield again. And I'd like you to zoom in on these economic contractions. When we see the labor market spike, what typically happens to the 10-year Treasury yield? It goes down. So the main takeaway from step number 1 is if we want to be able to better predict where interest rates are headed, we have to start by looking at it through the lens of growth and inflation expectations. And what's going to drive growth in inflation expectations to a significant degree is the labor market. So said another way, just hyper-focus on the labor market, and this is going to give you most of the data you need. So then the question becomes, okay, George, I get it. It's all about the labor market, but the labor market is a lagging indicator. So is there anything else out there that will give me more advance notice, that will tell me what's happening with the real economy, therefore the expectations, before we see a big spike in the unemployment rate, and I've probably missed the big move in interest rates? The good news, the answer is yes. It takes us right back to this incredibly powerful AI tool I have discovered that I'm going to share with you right now. Step number 2. Now let's go into the details of what this tool is, how it works, and what it's telling us about the economy right now compared to another time in history when the economy was rather volatile, let's say, and that's the GFC, 2008. So first and foremost, we've got this tool broken down into leading indicators and then confirming indicators. Now, I also want to mention, because I know a lot of you are probably very tech savvy, this isn't necessarily an AI tool. It was a tool that was created and indicators that were created using AI. And yours truly created these indicators using AI. So whatever you want to call it, this is going to give you a significant edge in determining the direction of interest rates in 2025 and into the future. That's all that matters. Okay, so we start with these leading indicators, and how I came to the conclusion is I first and foremost had 20, 30 of these, let's say, indicators, and using AI, I back tested all of them to determine which ones were the most powerful and which ones had the most predictive power. So right here, we've got initial jobless claims, continuing jobless claims, 2-year, 10-year Treasury spread, truck transportation jobs, and construction employment. You'll notice a lot of this, again, revolves around the labor market. So what I think a lot of you will find interesting is if you compare where we are today to where we were in, let's say, May of 2008. You can see the last time I pulled up the data was May of 2025. I realize that was a little while ago, but the concept is still the exact same. So initial claims, in fact, they just came out today in June 5th to be exact, and they were right around 247. So this has gotten, it's still yellow, but it's gotten a little bit worse. And what we did here is I just used traffic signals to tell you that when the recession probabilities, or not necessarily recession, but when the contraction of the economy, in other words, growth and inflation expectations were really declining, that's where you see a red. And if growth and inflation expectations should be increasing, then that's when you're going to see a green, obviously yellow, right in the middle. So we would still be at yellow, and going back to 2008, definitely a red there. In fact, every single input was red back in May of 2008. Where today, we've got 3 yellows, a red, and a green. There we go. Now, this is construction employment. If we go to a chart, a Fred chart, you'll see that every single time we get a recession, and this is going back to the 1940s, for heaven's sakes, almost every single time you see a big dip in construction employment. Now, it is true, we had some anomalies back in 1945, it looks like, maybe 1953. But for the most part, especially more recently, if we do get growth and inflation expectations going down, economic contraction, recession, whatever you want to call it, you see that it coincides with construction jobs going down. And right now, they've flattened out a little bit, but they're definitely not declining. So the main takeaway from the leading indicators is if all of these are lining up red, there's a high probability that if the unemployment rate hasn't spiked, it's going to spike in the near future. It's not a matter of if, it's only a matter of when. And when that unemployment rate spikes, the expectations go down and interest rates would likely come down with it. Now, on the flip side of the coin, if all of these signals or lights turn green, then it's the complete opposite. We should not expect a spike in unemployment. We might see unemployment go down even further. And in this case, the economy would be heating up, most likely, and you'd see interest rates increase. Now, moving on to the confirming indicators, and I use the exact same process here. I started with maybe 20 inputs and tried to narrow it down as much as I could to get to the ones that were the most powerful. And what I want to highlight here is when you see a red flashing signal on these, it doesn't necessarily mean you're headed for an economic contraction. It means you're likely already in one, regardless of what the NBER is saying. So we've got non-farm payroll growth. We've got core CPI, the SOM rule, loans, leases, credit card delinquencies, mortgage delinquencies, the restaurant performance index. This is something you don't hear people talk about a lot, but when I back tested it, it was very, very accurate. Price of oil, and then subprime auto delinquencies. So long story short, back in 2008, May, when we know we were in an economic contraction and rates were just about ready to plummet at the long end of the curve, we had a little bit of a mix. We had 6 reds and 3 yellows. Where today, not as bad. We're pretty much the opposite. We've got 6 yellows and only 3 reds. Now, this doesn't show us that the economy is booming by any stretch of the imagination. It's what I call a stuck in the mud economy. You're just not really getting any growth. It's very sluggish. The data is softening. You might tip into a recession, but currently you're not at a point where you would expect to see the unemployment rate skyrocket, and therefore growth and inflation expectations plummet along with interest rates. The last one that we're going to discuss gets a little wonky here, but I use it for a measurement, a true measurement of liquidity, because I don't believe liquidity comes from the central banks. I think it comes from the commercial banks in the monetary system. They can create as much liquidity as they want. It all depends on the risk versus reward. So if we see the banks going risk off, and we see the banks in their actions telling us they are predicting interest rates will be lower or higher in the future, we have to factor that into our predictive model. So I'm not going to go over all these because they get very technical, but the one I want to focus on, and the one that you can focus on, is swap spreads. So right now they are negative. The bottom line, this is a huge, huge red light. And what this tells you, if the 10-year swap spread is negative, as an example, that the market is predicting that over the long run, interest rates will be lower than they are today. So the main takeaway from step number 2 is if I could just give you 3 inputs to watch with this AI model I created. Number 1 would be initial claims. Number 2 would be non-farm payrolls, and number 3 would be swap spreads. When you see these turn green, you can expect that interest rates will likely trend higher in the future.
If it's yellow, that basically means that for the foreseeable future, you should expect interest rates to trade within a certain range. And then if it's red, this means that growth and inflation expectations are decreasing, and you should also assume interest rates will do the same thing. But what I want to emphasize is there's a lot of noise in interest rates. Nothing goes up or down in a straight line. So whether it's red, yellow, or green, remember, this doesn't necessarily tell you what's going to happen in the next 5 minutes or tomorrow. It really just tells you what's likely going to be the trend.
Step number 3. So now let's go ahead and put everything together to give you some actionable intel you're not going to hear anywhere else. But before we do, editor, let's cut to check out today's sponsor, Monetary Metals. This is the place you can store your gold and actually get paid in gold. And if you don't own any gold right now, especially in today's day and age, what on earth are you doing? So first and foremost, get some gold. And then check out Monetary Metals. Editor, cut to the clip.
Hey guys, I wanted to take a quick break from the video to share with you a new investment strategy I've been using. Most of you know the cornerstone for my portfolio is physical gold. The problem is you always have a negative carry because you have storage fees. Same thing with silver. But I've actually found a way that you can be paid to own physical gold and silver. And here's the best part. You're not just paid an interest rate in fiat currency, you're paid an interest rate in more precious metals. Now, I know a lot of you are saying, oh, George, this sounds too good to be true. And it's exactly what I thought when I first heard about this. Here's the backstory. I get a lot of businesses that come to me and say, George, we want to sponsor your videos. Usually I turn them down because it's not really a good fit. But I had a company come to me the other day called Monetary Metals. And when they were walking me through what they do in their business model, I thought to myself, this is a complete no-brainer. In fact, it sounded so good, I set up an account myself, and it's been going extremely well. So I said, sure, sponsor a couple videos because this is a service that I think would be hugely beneficial to my audience. So here's how it works. You can go ahead and set up an account with them and fund it with your existing precious metals, or you can buy directly from them, usually a little less than 1% over spot. And right now, as we speak on the platform, there's opportunities to be paid about 4% interest. So again, this is not in fiat currency. They're paying you in additional precious metals. So if you deposit, let's say 100 ounces of gold with them, at the end of the year, you'll have 104 ounces of gold. So to join the thousands of investors, including yours truly, who are being paid to own physical gold and silver, you can go to monetary-metals.com/gammon. That's monetary-metals.com/gammon.
Now, let's quickly review what we've discovered so far in this video. First and foremost, interest rates at the long end of the curve are really driven by growth and inflation expectations. Also, after all the AI-powered research that I've done creating these models and these indicators, the main takeaway for the average Joe and Jane is to really focus on 3 main indicators. Number 1, initial jobless claims. Number 2, non-farm payrolls. And number 3, the interest rate swap spreads, which we know are negative. So right now I want to focus on the first 2. And remember, the initial claims is kind of more of a leading indicator, where the non-farm payrolls more so a confirming indicator. So let's start by looking at a chart here going back to July 2023. It's about 2 years. On the left we go from 0 up to 500,000. This is the infamous non-farm payrolls. So just the other day, initial claims came out at 247. I think we mentioned that in step number 2. So it wasn't a horrible number, but it wasn't a great number, and we can see the trend starting to creep higher. This would tell us that there's softening in the labor market. And then we got that ADP number that we went over in step number 1 that was absolutely atrocious. But the market's going to pay more attention to what's happening with non-farm payroll, whether that's right or wrong. That's a discussion for another video. So looking at where we're starting here, July 2023, just under 250,000. So these 250,000 jobs added for the month. And then we kind of go up and down, but you can see this trend is really going lower until we get to this point where it really skyrockets. What happened here? Well, that was Trump winning the election. So you have all of these animal spirits because everyone thinks that Trump is going to be great for business. So they're hiring all of these employees to handle this massive amount of demand they think they're going to get. But then we kind of get past that honeymoon phase, and then we start talking about tariffs and a lot of these things that lead to uncertainty or instability, and we go right back down to kind of where we were with this trend, which is lower. So if you had to look at this chart alone and nothing else, what would you say interest rates did on the 10-year Treasury over the last 2 years? Editor, you can go ahead and cue the Jeopardy music. Well, now let's add one more thing before you give me your final answer. Remember, right about here, we had some inflation expectations really go up due to the tariffs and also due to the Fed, because everyone thought the Fed was dropping way too quickly relative to the strength of the economy. So we had this whole narrative about how inflation is going to skyrocket. So you combine what's happening with the tariffs and the Fed. This would be inflation expectations, and this would be a representation of growth expectations. So now, go ahead and give me your final answer. What do you think happened to interest rates on the 10-year Treasury? Editor, go ahead and throw up a chart, and you can see that the 10-year Treasury yields did probably what most of you expected they should have during this time frame, as they went up slightly. So the key moving forward is to really focus on what you think is going to happen with expectations. Now, if we see initial claims start to go down and we see the non-farm payroll numbers start to increase, well, this is giving you a good idea that all else being equal, you should expect interest rates to start going up. But assuming that the inflation expectations are pretty much flat, if you start to see those initial claims really start to skyrocket, so go up to 350,000 as an example, and then you see the non-farm payrolls start getting closer and closer to zero, even negative, then you know that interest rates are likely going to follow. And let's assume the 10-year Treasury is at 4.4 right now. If you start to see the latter, initial claims and non-farm payrolls deteriorating, you should see the 10-year Treasury going down probably south of 4%. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here, and I will see you on the next video.